I need to confess something before we start. I have a bias, a deep, structural, documented bias that affects every piece of analysis I produce on this channel. And if I don't tell you about it up front, everything that follows is contaminated. So here it is. I am wired to avoid loss more than I am wired to chase gain. That's not a personality trait I chose. It's a neurological architecture that evolution installed in my brain and in yours millions of years before either of us ever heard the word silver. And today I'm going to show you how that wiring explains not just why I invest the way I do, but why you invest the way you do, whether you own silver or not, whether you think silver investors are geniuses or lunatics. Because the psychology I'm about to walk you through doesn't just apply to metals. It applies to every financial decision you've ever made. And the person who understands their own wiring makes better decisions than the person who doesn't. 4 investor archetypes, 1 psychological trap that catches all of them, and a 10-second self-test at the end that will tell you whether your silver position is strategy or anxiety. Stay for that test. It's the most important thing in this video. Ken AG here. Let's go inside. Disclaimer, this is education. Not financial advice, not a recommendation, not therapy either, although some of us probably need both. All right, let's start with the science that runs your financial brain, whether you know it or not. In 1979, 2 psychologists named Daniel Kahneman and Amos Tversky published a paper that would eventually win a Nobel Prize. The paper described something called prospect theory, and the core finding was deceptively simple. The pain of losing $100 is psychologically approximately twice as intense as the pleasure of gaining $100, not equal, twice. Your brain is not a balanced calculator. It's a loss detection machine with a gain detection feature bolted on as an afterthought. Now think about what that means for investing. If your brain experiences loss at double the intensity of gain, then the person who builds a portfolio around not losing will feel psychologically different from the person who builds a portfolio around winning big. The first person sleeps better. The second person has more exciting dinner conversations. And over a 20-year cycle that includes at least 2 recessions, 1 currency crisis, and 1 event nobody predicted, the person who sleeps better tends to still have a portfolio. The person with the exciting stories tends to have exciting stories about the portfolio they used to have. This is the first key to understanding the silver investor. They are not primarily motivated by greed. They are primarily motivated by the avoidance of ruin. And that motivation comes from the deepest, oldest, most powerful part of the human brain. The part that kept your ancestors alive when the world was full of things that could kill them. The silver investor has simply redirected that survival instinct from physical danger to financial danger. And in a world of unprecedented debt, currency creation, and institutional fragility, that redirection might not be irrational at all. But here's where it gets complicated, because not all silver investors are the same. The loss avoidance wiring is the common thread, but it expresses itself in 4 completely different personalities, and each personality has a strength that serves them and a blind spot that can destroy them. Let me introduce you to all 4, and I want you to be honest with yourself about which one you recognize in the mirror. The first archetype is the hedger. This person doesn't make noise. They don't post screenshots of their stack on social media. They don't argue in comment sections. They treat silver the way an engineer treats a load-bearing wall. It's not decorative, it's structural. It holds up the building when everything else is under stress. The hedger buys silver as insurance against monetary erosion, diversification outside the banking system, protection in tail risk scenarios. They don't care if silver goes up 20%. They care that it exists when everything else goes down 40%. Their emotional baseline is calm. Their decision-making is systematic, and their portfolio reflects a single cold-blooded calculation. What is the minimum allocation that provides meaningful protection without sacrificing opportunity elsewhere? The hedger's strength is discipline. They don't overtrade. They don't panic. They don't chase momentum. Their weakness is complacency, because the hedger can become so comfortable with their insurance that they forget to monitor whether the coverage is still adequate. The world changes. Risk profiles shift, and the allocation that made sense 3 years ago might be woefully insufficient today. The hedger needs to periodically stress test their position against current conditions, not against the conditions that existed when they first built it. The second archetype is the contrarian. This person takes genuine intellectual pleasure in being early. Not early as in I bought before the price went up. Early as in I bought when everyone else thought I was wrong. The contrarian reads consensus as a counterindicator. When the crowd is euphoric, the contrarian gets nervous. When the crowd is dismissive, the contrarian gets interested. They don't buy silver because it's popular. They buy silver because, at certain points in the cycle, it's profoundly unpopular. And unpopularity, to the contrarian, is mispricing. The contrarian's strength is independence. They are naturally resistant to FOMO, which is one of the most destructive forces in retail investing. They don't buy at the top because the top is where the crowd is, and the crowd is exactly where the contrarian doesn't want to be. Their weakness is premature conviction. The contrarian can fall in love with being early so deeply that they confuse being early with being right. Being 3 years early and being wrong look identical on a profit and loss statement for 36 months. The contrarian needs to pair their independence with patience and the humility to acknowledge that being contrarian doesn't automatically mean being correct. The third archetype is the rational prepper. This is the most misunderstood personality in the silver space. The mainstream hears prepper and pictures someone in a bunker with canned food and a conspiracy wall. The rational prepper is nothing like that. They're usually quiet, methodical, and well-read. They don't prepare because they're afraid. They prepare because they've studied enough history to know that supply chains break, currencies fail, institutions default, and rules change. Not as catastrophic once-in-a-millennium events, as regular documented recurring features of human civilization. The rational prepper buys silver in small, divisible units for maximum optionality. They want something they can use if the banking system experiences disruption, not because they expect disruption tomorrow, because they've read enough about Cyprus, Lebanon, Argentina, Greece, and Venezuela to know that disruption is not a hypothetical, it's a recurring event that most people choose to ignore until it arrives. The rational prepper's strength is anti-fragility. They've built a financial life that doesn't depend on any single system working perfectly. Their weakness is isolation. The rational prepper can become so focused on preparing for dysfunction that they underweight the possibility that the system continues functioning adequately for a long time. Preparation that costs too much in opportunity or social connection becomes its own form of fragility. The rational prepper needs to stay engaged with the world they're hedging against, not retreat from it. The fourth archetype is the collector. This person is in it for the metal itself. The weight of a kilo bar in your hand. The ring of a silver eagle on granite. The history embedded in a Morgan dollar. The aesthetic satisfaction of a perfectly organized stack. For the collector, silver isn't just a financial instrument. It's a ritual, an identity, a relationship with physical reality in an increasingly digital world. The collector's strength is commitment. They will never sell their silver in a panic because their attachment to the metal transcends the price on the screen. They hold through drawdowns that would shake out any speculator. Their weakness is exactly the same thing. When an asset becomes your identity, you lose the ability to evaluate it objectively. Every piece of negative data gets filtered through the question, what does this say about me, rather than, what does this say about the market? The collector needs to periodically separate themselves from their stack, psychologically, and ask whether they would build the same position today if they were starting from scratch. If the answer is yes, the conviction is rational. If the answer is, I can't imagine not owning this, the conviction might be emotional attachment wearing a rational mask. Now, here's where this video takes a turn. Because everything I've described so far is the light side of silver psychology, the adaptive side, the part that serves you, but there's a dark side. And if I don't talk about it, I'm not being honest with you. And honesty is the only thing this channel sells. The dark side is confirmation bias, and it is the single most dangerous psychological force operating in the precious metals community today. Confirmation bias is simple. Your brain preferentially seeks, remembers, and amplifies information that confirms what you already believe. And it preferentially ignores, forgets, and minimizes information that contradicts what you already believe. This isn't a character flaw. It's a feature of human cognition. Every brain does it, mine included. Yours included, the Nobel laureates included. In the silver space, confirmation bias looks like this. Silver drops 5%. The hedger says manipulation. The contrarian says buying opportunity. The rational prepper says system stress. The collector says discount on my favorite metal. Nobody says maybe the fundamentals weakened. Nobody says maybe I'm wrong about the timeline. Nobody says maybe I should re-examine my assumptions. Every archetype has a built-in narrative that absorbs negative data and converts it into reinforcement of the existing thesis. And that is incredibly dangerous because the moment your investment becomes unfalsifiable, the moment no possible data could change your mind, you've stopped investing and started believing. And believing in financial markets is the precursor to being blindsided. I've watched this happen in real time. In 2011, silver ran from $30 to nearly $50 on genuine fundamental strength, supply deficits, inflation fears, dollar weakness. The thesis was sound. But by April 2011, the community had crossed the line from thesis to religion. Every voice that suggested caution was dismissed as a paid shill. Every pullback was manipulation. Every rally was confirmation that $100 was inevitable. Then, margin requirements increased 5 times in 9 days. Silver crashed from $49 to $26 in 5 months, a 50% decline. The fundamentals hadn't changed dramatically. The sentiment had become so one-directional that there were no buyers left when sellers appeared. And the people who lost the most were the ones whose psychology had made it impossible for them to consider the possibility of being wrong. That's not a silver problem. It's a human problem. But silver's volatility, its passionate community, and its countercultural identity make it uniquely susceptible to this trap. So how do you protect yourself? How do you keep the psychological advantages of the silver investor, the loss avoidance, the independence, the preparation, the commitment, without falling into the confirmation bias trap? I'll give you 3 rules that I use myself. Rule 1, actively seek the strongest argument against your position. Not the straw man argument, not the dumb version. The best, most articulate, most data-supported argument that your thesis is wrong. If you can't state that argument clearly and fairly, you don't understand your own position well enough to hold it, because you haven't stress-tested it. You've only admired it. Rule 2. Define in advance what would change your mind. Before you take any position, write down the specific conditions under which you would exit. Not vague conditions, specific ones. If registered inventory rises above X for Y months, my thesis weakens. If the deficit reverses for 2 consecutive years, I reassess. If the price drops below Z and stays there for 6 months, I reduce exposure. Having these pre-commitments in writing removes the emotional decision from the moment of stress and puts it back into the moment of clarity when you first built the position. This is the difference between a trader and a believer. A trader has exit criteria. A believer doesn't need them because they're never wrong. Rule 3, separate your identity from your portfolio. You are not your silver stack. Your intelligence is not validated by silver's price going up. Your judgment is not invalidated by silver's price going down. Silver is a tool, a useful, historically proven, structurally sound tool. But tools are things you use, not things you are. The moment you catch yourself defending silver the way you defend your family, take a step back, because that's confirmation bias wearing an emotional disguise. And it will cost you money, clarity, and possibly relationships. Now, the self-test I promised you, 10 seconds, 1 question, and it requires brutal honesty. Ask yourself this: do I invest in silver because it gives me peace? Or do I invest in silver because I'm trying to escape every uncertainty in the world? One of those is strategy. The other is anxiety dressed as strategy. And the difference between them determines whether your silver position serves you or whether you serve it. Peace means you've done the analysis. You've sized the position appropriately relative to your total financial life. You've defined your time horizon. You've accepted that silver will be volatile, that it will have drawdowns, that it will test your patience. And you've concluded, calmly, that the risk-reward of holding this insurance makes sense for your specific circumstances. You don't check the price every hour. You don't need silver to go up to feel good about yourself. You own it the way you own homeowners insurance. It's there. It's sized. It's forgotten until the day you need it. Escape means something different. Escape means silver has become the solution to every anxiety you feel about the world, the economy, the government, the banking system, the future. You've loaded onto silver not just financial expectations, but emotional ones. You need silver to validate your worldview. You need the price to go up not because of the financial return, but because it would prove that you were right about everything you believe about the system. And that need, that emotional dependency disguised as financial strategy, is the most expensive bias in investing. Because it makes you incapable of selling when you should. Incapable of reducing when the position is oversized. Incapable of hearing information that contradicts your thesis. Incapable of acting in your own financial interest when your emotional interest points the other direction. Peace is the goal, escape is the trap, and every single one of the 4 archetypes, the hedger, the contrarian, the rational prepper, the collector, is capable of both. The archetype doesn't determine the outcome. The self-awareness does. The truly wealthy, the people I've studied who navigate monetary transitions successfully across decades, share one characteristic that has nothing to do with the size of their portfolio. They hold their convictions firmly and their identities loosely. They believe in their thesis, but they don't need their thesis to be true. They own silver because the math supports it, and they would sell silver the moment the math stops supporting it, without experiencing it as a personal loss. That detachment, that ability to use a tool without becoming the tool, is the psychological edge that no chart pattern and no macro model can give you. You have to build it yourself, through practice, through self-examination, through the uncomfortable discipline of questioning your own beliefs on a regular schedule. Silver is a remarkable asset. It has preserved purchasing power across millennia. It serves a dual function as monetary insurance and industrial necessity that no other element on the periodic table can match. The people who hold it thoughtfully, with clear purpose, appropriate sizing, and psychological self-awareness are playing one of the most intelligent, long-term games available in modern finance. But silver doesn't care about your feelings. It doesn't know you own it. It doesn't reward loyalty. It rewards clarity. And clarity starts with knowing why you're really in the trade, not the reason you tell other people. The reason you tell yourself at 2 in the morning when the market is closed and nobody's watching. That's the psychology of a silver investor, not the metal, the mirror. Tell me in the comments which archetype you recognized: hedger, contrarian, rational prepper, collector. And tell me honestly, did the self-test give you peace or did it make you uncomfortable? Because the ones who felt uncomfortable are the ones who needed this video the most, and they're the ones who will benefit from it the most. I want to hear from you. If this video changed how you think about your own investment psychology, hit the like button. This content needs your help to reach the people who need it. Subscribe and hit the bell if you want analysis that respects your intelligence. Every Saturday, free weekly market breakdown based on my 8-indicator model. Share this with someone in the silver community who might be crossing the line from strategy to belief without realizing it. Not to argue with them, to give them a mirror. As always, take care of yourself and each other. Your friend Ken AG. Build that stack, but build it with clarity.